Audio Jungle. Audio Jungle.
When we look at the investing landscape in India, there were a total of 7,462 companies listed across India during the financial year 2021 in the National Stock Exchange (NSE) as well as the Bombay Stock Exchange. And for a newbie stepping into the market, a major question arises that, well, how am I supposed to know which companies to invest in and which companies to stay away from? And how can we even look for those great stocks out of this gigantic list? Should I copy that great investor, or should I listen to Mama ji or Chacha ji or that uncle from the neighborhood who seemed determined to ruin my investing career? At least we don't agree with these approaches. According to the legend Warren Buffett, you can't buy what is popular and do well. This is the reason we have compiled a step-by-step guide for beginner investors and relatively experienced ones alike, so that you guys can find those best stocks. In this video, you are gonna learn importance of determining your investing goals in the beginning before you step into the thick and thin of Indian stock market, and just how to find those companies which you understand. How do companies with certain competitive advantages, and how to find companies selling way below their real price? Why is the margin of safety a cruel concept to understand in the Indian stock market? Determining your investing goals is the first and perhaps one of the most important steps in your journey to financial freedom through stock market investing. For example, people in their 20s or 30s will probably incline towards diversifying their portfolio over a long frame of time. Similarly, the older ones will try to look to invest in stocks for capital preservations, as they are looking to retire or live off their holdings. And then we have people who want to generate some passive income. People who want this constant income flowing into their bank accounts. It can be in the form of dividends or governmental bonds, ETFs, etc. So before you start throwing your money into different companies without any long-term goal, take some meditation time out and ask yourself what is the goal you are looking to accomplish, and then start investing in stocks. With that being said, here is the first step to finding the best stocks to invest in. Look for companies you understand. So who makes those medicines or drugs at the pharmacy store, and what components are they using? Who made the bicycle which is so popular among children, and what parts are they usually using? Who manufactured that machine which takes your cash at the supermarket? Which parts did they change in that new Maruti Suzuki? And are these parts better than the ones Hyundai uses? If you don't understand how a business is actually minding its own business, then you probably need a lot of upfront research or look for another company. Simple as that. Let us just say that you decided to invest in Airtel as you were impressed by its market capitalization of more than 53 billion US dollars. Now probably everyone has an idea that Airtel deals in the telecommunication industry. When buying the shares, you are actually buying an ownership, however small it may be, of the respective company. Let us suppose you don't know anything about its marketing strategy, the products it is planning to bring forth, and the quality of management. Then just how will you be able to know anything about its profit and loss? If you are investing blindly, then you are just setting yourself up for a disaster. So remember, research, understand the underlying business model, and look for a company with a competitive advantage. You guessed it right. That brings us to the second most important step: looking for a company with a competitive advantage in the market. Putting first things first. What is a competitive advantage of a company? In stock market language, Any company holds a competitive advantage if it holds more than customers than its rival companies in the same industry. To put it simplify, if a company is holding a competitive advantage, that means this company is producing a product that is better and cheaper in quality than the product produced by its rival companies. According to Warren Buffett, the key to investing is not assessing how much an industry is going to affect society or how much it will grow, but rather determining the competitive advantage of any company and, above all, the durability of that advantage. Now, for an example, let us just suppose that you have decided to invest in Nestle India because you completely understood the business model. Now the question arises, does Nestle India have a competitive advantage in the niche? In simpler terms, companies with a competitive advantage outperform other companies in the same niche. You need to answer questions like, do they have more customers than other companies of the same line? Is their management working hard to keep the company stable? And moreover, which product are they bringing in? For example, Warren Buffett decided to invest in Coke stock when he discovered that it was the most popular stock in the niche. When he was walking on the footpath, he noticed that in a plethora of bottle caps, the Coke bottle caps outnumbered all the other ones. In investing, the stocks which hold a competitive advantage over other stocks are known as the moat stocks. You might be wondering what a moat stock is. A moat is an ancient word that was used for the big ditches surrounding castles, and these deep grounds protected the castles from foreign invaders. In investing language, a moat stock is a stock that is monopolizing the market due to its business advantage and big capital gains, and they have made it hard for other companies to compete with them. Examples of such stocks in the Indian stock market can be HAL, the Hindustan Aeronautics India Limited, Coal India, Pidilite, Nestle India, Reliance Industry, BHEL, which is India's largest engineering and manufacturing enterprise, and Marico Oil Products, etc. After getting hold of the companies with a competitive advantage, the list of these listed companies in the Indian stock market will be refined up to a certain extent, and this brings us to the third step, the price of a company. It's finally time to start looking at the prices of these stocks. When you are looking at the stock's price, the first and perhaps the most important parameter you need to be analyzing is the price to earning ratio. To calculate the PE, you need to take the share price of the company you are targeting and divide it by its earnings per share. Now, if you find the PE ratio below its historical average, you can pretty much conclude that this company is growing and it's a must buy. The next metric you can use to select stocks is the price to sales ratio. Now, some stocks produce unstable earnings, and the PS ratio comes in handy for growth stocks. And similarly, if you are focusing on dividend stocks, then the metric known as the dividend yield can come in handy. For example, if the dividend yield is above the historical average, that means that the stock is trading at a good price, and it can result in some serious profits in the long run. After studying these metrics in detail and the pricing of a stock, then comes the concept of the margin of safety. Imagine you are driving a truck, and on your journey towards your desired destination, you come across a bridge that shows that it has a bearing capacity of 10,000 pounds. Your truck weighs 9,000 pounds. Will you even dare to cross it? The obvious answer, if you wanna live longer, is that you will take a route around the corner and steer away. The same concept is applicable when buying stocks. Buy a stock with a margin of safety. You should always look to buy companies trading way below than your limit for a fair price. People need to understand that not every valuation you are making is gonna end up being 100% accurate. There can be some ups and downs. So if your valuation was meant to be south but the market says north, then you can prevent big losses by buying stocks at a margin of safety. According to investing legend Charles Munger, the idea of the margin of safety, a Graham precept, will never be obsolete. In the Indian stock market, if you find a stable stock with a great business model, you might not need a big margin of safety. All you need is to take 10% off your target price. And that should be good. And similarly, if you are looking at growth stocks with unstable earnings, you can always aim for a margin of safety, somewhere around 15% to 30%. And that depends on how good and reliable you are with quality valuations. For example, if a small company or a young company faces a new challenge, or a large company decides to step into the market, you will be safe because you already bought a stock at a relative value. The margin of safety is what gives you a safety cushion in the stock market. So these were the steps every beginner investor should follow to start his or her investing journey in the stock market. Let us know about your investing journey, and if you want us to make a separate video on the margin of safety, let us know in the comment section below. Make sure you press the like and subscribe buttons, so we will see you guys in the next video.